We will now begin the question and answer session. People dialed in, if you have a question, please press star 1. If you wish to be removed from the queue, please press star 2. We will now hand you over to Mr. Ben van Beurden. Please go ahead.
Okay, welcome now to the live section of this morning. Jessica is here with me and we both look forward to answering your questions. So please keep your questions brief and may I suggest no more than 2 questions each. So Marion, can we please have the first question?
Thank you. The first question comes from Sarah McFarlane from Wall Street Journal.
Morning, Ben. Morning, Jessica. I was wondering whether you could give thank you. I was wondering if you could give an update on your demand outlook. When do you see demand rebounding to pre-pandemic levels? And I also wondered what your outlook was now for gas as a bridge fuel, whether that bridge is getting shorter. Thank you.
Thanks, Sarah. I'll take both of the questions, actually. I think if you look at the demand outlook, it's a bit of a mixed picture. In different parts of the world, we basically see a recovery. Take China, for instance. If you look at January versus January, we actually not only see a recovery, we see 15% growth in our retail business. And even on December to December, we see significant growth. Altogether, though, it's fair to say that we probably see not a complete recovery. We're probably still some 5 to 7% behind. I think that recovery will probably have to wait until, indeed, we see also a recovery of the aviation sector, which is a significant driver of demand growth as well. But we do believe the second half of this year, we will see a strong recovery. And I believe 2022 is going to be sort of back to normal. On natural gas, I don't think that we have changed our outlook on it. Natural gas will still be a very important fuel for the future as the world abandons coal quite quickly, and not just in power generation, also in industrial use, and of course also in domestic use, and even in transport use, we see the demand for gas rising, and as a result of it, we see growth in LNG. And I think still up to 4% per year growth for a long time to come is still the outlook that we are looking at. Thanks, Sarah. Marion, next question, please.
The next question comes from Ron Baruso from Reuters. Please go ahead.
Hi, Jessica. Hi, Ben. I hope you're well. I have 2 questions. First of all, about your oil and gas reserve, which has fallen, and they're already quite at the very low end. And I know you say that this is a new metric. I mean, this metric is not really relevant anymore, but it's still important if you want to produce oil and gas. So are you doing anything towards boosting your reserves these days? And second question about Nigeria. Obviously, the court ruling last week was a blow to Shell. There's the OPL 245 issue and just the PIB as well. So are you rethinking Nigeria? I've asked you before, but again, is Nigeria worth staying in for Shell? Thanks.
Thanks very much, Ron. Let me take the second question, and Jessica will take the first one. On Nigeria, yeah, indeed, we did have a ruling that, well, on aspects indeed went against us, not all of that, but for that matter, Ron. This is an old matter. It is a dispute about a leak that occurred in the early part of this century, where we believe the leak was caused by sabotage, and the judge ruled that that could not be proven beyond reasonable doubt. So therefore, indeed, we are liable for damages. As a matter of fact, we did clean up the spill, of course. We clean up every spill, and the judge also ruled that the cleanup of the spill was actually perfectly adequate. But I think what it shows is indeed that our onshore oil position, despite all the efforts that we put in to really go against theft, sabotage, etc., is under challenge. And the joint venture does a great job, SPDC, to combat it and to deal with it, but at the same time, it remains a headache dossier. Now, of course, SPDC has divested roughly 50% of its footprint in the last 10 years. But I think, developments like we are still seeing at the moment means that we have to take another hard look at our position in onshore oil in Nigeria. Thanks, Ron. Jessica, can you take the first question, please?
Sure, Ben. Ron, thank you for the question on reserves. I was expecting some interest in those numbers. Reserves are important in terms of their relationship to our cash flows. And in terms of our cash flows, I have complete confidence in the fundamentals of our upstream and integrated gas business and the cash flow outlook for the coming decade. The reserves outcomes of this year reflect a very low price environment and also some deferrals that we've made. But many of those are in fact deferrals, and those options or those the ability to produce some of those reserves, while they may have shifted to contingent, still remain in terms of the options within the portfolio. So the fundamentals of the business, I think, remain strong. This year was extraordinary in many ways. That did have an effect on our reserves position. I'd also point out that reserves for our business and our strategy has not always been the best indicator of future cash flows because of the strength of our deep water, our LNG business, and also our shales business, which don't always correlate or align very well to the reserves booking methodology. So overall, I don't think there's any underlying issue, and we have a lot of confidence in terms of the underlying cash flow of our businesses.
Okay, thanks, Jessica. Thanks, Ron. Can I have the next question, please, Marion?
The next question comes from Bert van Dijk from Dutch Financial Daily.
Yeah, good morning, Ben and Jessica. Two questions, if I may. The first question is about Prelude. It came back online recently, but it seems that that some recent cargo schedules have been deferred as well. Can you give me an update on the status of Prelude at this moment? And my second question is about the impairment charges you made in the Netherlands and Singapore, especially in the oil products section. I was wondering if you could elaborate a little bit on the impairment charge that you did in the Netherlands. Thank you.
Thanks very much, Bert. Let me talk about Prelude. Jessica will talk about the impairments. So Prelude, indeed, we have had Prelude down for some time to make sure that the issues that we were encountering in the early phase of operations were being addressed. We addressed them carefully, safely, but of course also under challenging circumstances. As you can imagine, Bert, it's difficult to fly out people and parts and everything else under pandemic conditions, especially to a country like Australia. But we addressed the issues. We started it back up. It is not yet at full capacity. We still have a few things to resolve. But we did load the first cargoes. I think we are at cargo number 3 now since the beginning of the year. And hopefully soon, when we have addressed the next issue that needs to be resolved, we will be stepping up capacity. And we will be stepping up, of course, then the number of cargoes further again. Jessica, the impairments in Singapore and in Pernis.
Bert, thanks for your question. Two pieces to the impairment story I'd like to share. The first one is we typically have a value erosion review, impairment review post our planning process, which we do in the third quarter. So this is a normal process that we have each year, and it's not uncommon for us in the third or fourth quarter to have impairments because of that review process. With respect to the Netherlands and Singapore, this also reflects what's going on within our downstream portfolio more widely as we have shifted our strategy to the 6 energy and chemicals parks of the future, and we're repurposing those assets for the future of energy. And that's having implications in terms of some of the asset values that you see coming through. The Netherlands specifically was relating to a different profile in expenses, some of which is tied to, as I said, the change in strategy and repurposing our assets for the future of energy.
Thank you very much. Marion, can I have the next question, please?
The next question comes from Anjali Raval from Financial Plan.
Hi, Ben. Hi, Jessica. I hope you're staying healthy and sane in these mad times. But look, forgive the bluntness, but is the dividend raise again, a genius move by Shell at a time of huge scrutiny and pressure on big oil, or is this just a massive flip-flop in response to shareholder opposition that Shell is scrambling to fix? That's the first question. And the second is really just on impairments broadly and how we should be thinking about this. Obviously, we've seen a lot being announced by Shell since the company's readjusted longer-term energy prices. What does 2021 hold? Are you able to give any colour?
Thank you very much, Anjali. And yes, I'm doing well, and I believe Jessica as well. I hope you are doing well as well. Let me take the first question. Jessica will talk about the impairment question. So we've been very clear about the dividend. When we had to reset it, which was of course a very painful decision that we had to take, but also a very clear decision that we felt we had to take last year, we said we will have not only a reset dividend, but it will be a progressive dividend. And maintaining that progressive dividend will be one of our top priorities. And in October last year, we were very clear about what a progressive dividend means. In October, I spoke about we will be entering another era of dividend growth, and we increased the dividend at that point in time with 4%. And we indicated that is what we will be doing on an annual basis, subject to board approval, of course. Now, we had our board meeting yesterday. We typically take a dividend decision in the first board meeting of the year, which will then come into effect in Q1. And indeed, as we more or less said we would do, we increased the dividend for the first quarter with 4%. That was a decision that in principle we had taken earlier last year and confirmed to the market in October. Jessica, on the impairments?
Anjali, thank you for the question. And again, a question I expected to hear today. The impairments of 2020 were significant. That's important to acknowledge. There were three main drivers of the impairments over the year. The first one was the pandemic and the dramatic impact that had from a macroeconomic perspective and from a price and margin perspective. The second piece is what we're seeing as an acceleration of the energy transition. That also influences our view of long-term prices and margins. And then the third piece is the reset of our strategy that we put in place in 2020 and are obviously going to execute from 2021 forward. All three of those drivers affected the view of the value on our balance sheet and led to those impairments. In terms of going forward, our balance sheet reflects the value that we see of the company today, and from that perspective, I don't anticipate any further impairments. If I did, they should be reflected. I think we've taken a lot on board this year in terms of rethinking of our price and margin outlook, so I wouldn't expect major changes there. We've just reset our strategy, so again, I don't think that should be a driver for us. So I'm feeling good in terms of certainly about the understanding of the balance sheet and the value of the balance sheet, and therefore wouldn't expect much change. But we are in a dynamic world. Prices and margins can move. If the pace of the energy transition slows down or accelerates, there could be different views then taken on prices and margins that would then be reflected in the balance sheet. But I think today is a fair and accurate representation of the value of our assets. Thank you.
Thanks, Jessica. Thanks, Anjali. And Marion, can I have the next question, please?
The next question comes from Laura Hurst from Bloomberg.
Morning, Ben and Jessica. I hope you're both well. So two questions from me. My first is, having to pay debt to pay the dividend is sort of what got you into trouble last time. So why are you doing it this again and increasing the dividend in the quarter where you haven't even covered it with your own cash? And my second question is on debt reduction. And basically, how are you going to cut debt if prices remain low this year? Do you have any room to maneuver?
Thanks, Laura. I think we do, but let Jessica take both questions in a bit more detail.
Oh, great.
Oh, sorry. Surprised you there?
Indeed,
we can't
indeed.
see each other because we are in different places in the building.
Indeed. In terms of our dividend profile, we made obviously a pretty difficult but prudent choice at the beginning of the year to reset the dividend. That, along with other important choices that we made and actions we took, reducing our OPEX, reducing our CAPEX, we in fact were able to reduce our net debt for the full year by some $4 billion, which I think is demonstrating sound judgment and sound performance in terms of delivering that outcome. So we did cover our dividends over the full course of the year, and as I said, reduced net debt on a full year basis. Going forward, in terms of the price environment, the macro environment, the ability to absorb changes, again, I think 2020 was a pretty extraordinary year. We had negative WTI, Overall average prices for the year were some $42. We had record lows in our margins, in our refining business, et cetera. And against that backdrop, we generated some $34 billion of cash. And as I said, we were able to reduce our net debt and pay our dividends. So I think we've demonstrated the financial resilience of the company in very difficult circumstances. I don't think 2021 will be a repeat of 2020. I do believe that there'll be a recovery on the horizon. In addition, we also are making some important moves from a portfolio standpoint. In the fourth quarter, we announced 2 divestments, one in Nigeria and some infrastructure in Australia. The total of those 2 divestments are some $3 billion, and we expect that cash to be coming in the first half of the year. So that also builds up some further financial resiliency as we continue our divestment program, which we're looking to get about another $4 billion a year. Depending how it goes, it could be higher than that or potentially lower, but at least we're looking for at least $4 billion a year as additional resiliency to the already fundamentals of the business that I spoke to.
And let me add to it. I understand the focus on the oil price and gas prices, and indeed it is a very important driver of cash and earnings. But can I also remind you that we have a very significant part of the business that is independent of these type of macro indicators. Our marketing business had one of the best years ever, if not the best year ever. If I look at retail, we actually improved earnings with 5% in a very difficult year. Lubricants, we improved earnings with 19% in a very difficult year. And that is against, a shrinking GDP of 4 to 5%. So indeed, it's not just the oil price, it is also our marketing business, our chemicals business, which is coming back. So altogether, I think we look into 2020 with a lot more confidence than the environment that we have seen in 2020. Sorry, did I say 2020? I meant 2021. Okay, thank you very much. Marion, can we have the next question, please?
The next question comes from John Maywaring from Energy Intelligence.
Hi there, good morning. Most of the questions that I had have already been answered, but one area I am interested in, and just following up on the question earlier about maintaining reserves, is how do you see yourself doing that in the future? Would it be through acquisitions or more exploration? And on the exploration point, how do you see the exploration function of upstream changing as we move through the decade? What will be its main priorities? Can we say that frontier exploration is a thing of the past, for example? And could you, as some other CEOs have said recently, could you repurpose exploration capabilities into other areas of your business?
Great question, John. Yeah, and let me take both of them. Exploration is an important part of our operations. Upstream is an important part of our operations, and it will remain a very important foundational business for years, if not decades, to come. Indeed, our reserve replacement ratio was not stellar in 2020, to put it mildly, but let me remind you the drivers behind it. It is, first of all, a lower year-end pricing, which from an accounting perspective drives down our reserve accounting. It is the fact that we postponed quite a few investment decisions to later, so that means less new bookings, which drives down our reserves replacement. And on top of it, we sold quite a few reserves positions as well. Think of the positions that we sold, for instance, in Appalachia. So these things are things that are, you could argue, a little bit one-off or are specific for the year, but we have every intention to look after our upstream business so that it will remain a very strong cash-generative business, not just for this decade, but well into next decade, because we see our upstream business as a very important foundation, not only for shareholder returns, but also to fund the transition that we are going to make in this decade and next decade into the future of energy. Now, does that mean that there is no role for exploration? And in that future, there will be a role, John, for exploration. And next week, we will say a little bit more about how we see that, where we will be focusing, but we will be focusing most of our spend, exploration as well as investment spend, on the 9 core positions that we have identified. 80% of our spend will go to these 9 core positions. 80% of our cash flows will come from these 9 core positions as well. Now, as to repurposing upstream, absolutely, we need to look at what other opportunities can we have with the very strong subsurface knowledge that we have. Earlier on, you heard Jessica talk about the future of energy, including carbon capture and storage. And indeed, we are looking very hard to understand how we can make carbon capture and storage, or carbon capture and utilization, as a key business model for the future. Again, it was one of the topics that we discussed yesterday in the board extensively, our plans, how we see this for the next decade or longer. And I believe, therefore, that our position in upstream, our position as an infrastructure player, our position also as a great interfacer and solutions provider to customers will actually help us with that business model of the future as well. Thanks, John, but come back next week when we talk a little bit more about this. Marion, next question, please.
The next question comes from Emily Gostin from The Times.
Oh, hi there. Thank you. Firstly, just looking ahead to next week, I wondered if you could help kind of manage our expectations at all. Obviously, you told us last quarter you didn't want to set a volumetric target for oil production declining. Lots of your peers have set very punchy targets for renewables deployment, whether you think that kind of thing is helpful. Secondly, I just wondered, I saw you sort of clashing perhaps with John Kerry a little bit on the panel last week about the potential need or otherwise for new drilling in the States. Could you just clarify what your position is in the Gulf of Mexico in terms of whether under your business as usual plans you would be anticipating getting new leases and new permits? And so sort of what impact any potential changes in federal policy would have there? And if I could just quickly sneak in one clarification on an earlier comment, you talked about demand being sort of back to normal in 2022. What do you mean by that? Has demand peaked, or are you talking about back to 2019 levels? Thanks.
Thank you, Emily. Let me talk about demand a little bit. Talk about, indeed, the US situation. Jessica will take the value versus volume debate on one more time. Now, I think when I talk about recovery, we are at the moment still a ways off from where we were, but particularly on oil, where, as I said, I think we're about 5 to 7% off from where we were in 2019. I think that will start to come back more in the course of this year, and it will probably be back to where we were in 2022. And as I said, a significant part of that shortfall at this point in time is not just sort of surface mobility, cars and trucks and everything else. I think aviation will be a very significant contributor to that remaining recovery that we need to see. Now, as to the United States, and indeed the dialogue that we had, and I had indeed a dialogue with Secretary Kerry last week at the WEF virtual event. I think, first of all, let me say that we very much welcome, of course, the stance of the new administration. We completely are with President Biden on rejoining Paris. We applaud that. We are completely with the President's ambition to be a net zero country by 2050. And we look forward to working with the administration to see where we can help, because we have the same goals, net zero by 2050, including our Scope 3 emissions. Now, on the matter of the leases, the pause in lease sales on federal land, and of course, for us, that basically means federal water, because we don't have federal land positions, but we do have federal water positions in the Gulf of Mexico. We can't see ourselves being affected anytime soon in that regard. We have a lot of lease positions, more than 300 lease positions, that will give us enough running room for the rest of the decade. So I don't see any economic impact from that position at this point in time. But there is an interesting point to make here as well, Emily, and I hope that point will resonate. Because, of course, curtailing the supply of oil and gas is not necessarily the solution for climate change. What will happen if we just don't produce these barrels in the Gulf of Mexico? They will be imported from elsewhere. And guess what? the barrels in the Gulf of Mexico are the most carbon-advantaged barrels that the US currently consumes. So it will not necessarily be an improvement. In that regard, I think it would have been much more interesting had the president announced a ban on the use of oil and gas on federal lands. That would have made a real difference and actually would have helped us a little bit with our business model in the US as well. But anyway, Jessica, to you.
Good morning, Emily. Thanks for the question. In every part of Shell, we focus on creating value rather than on any particular volumetric measure. And we create value, we think about value in terms of total NPV creation as well as the returns that we get on all of our investments. Sometimes that correlates to volumetric measures. It may relate at some level to production. It may relate at some level to gigawatt hours produced, but that's not always the case. And from a management perspective and a way of thinking about value in the company, we really emphasize the focus on value creation, which may not be correlated to volume. If a company focuses too much on volume, there's a lot of dead ends in that thinking, and we're trying hard not to go down some of those dead ends. In terms of our businesses, as Ben mentioned, our upstream business, we're focusing on the cash flow, the core assets that generate 80% of our cash flow. When you think about our renewables business and what we're doing in the energy solution space and biofuels and hydrogen, we're looking at creating solutions for customers. And our orientation is, what does the energy system need? What do the customers need in this energy system going forward? And to manage very complex changes in the energy system. So one of the examples given in the presentation this morning is what we're doing here in the Netherlands, taking wind power, creating green hydrogen to support our Pernis operations, and then ultimately to provide hydrogen for commercial road transport. The volume piece in that might be interesting depending on what part of the value chain you're looking at, but we're looking at that integrated return from a company perspective, and importantly, how do we create value for our customers? How do we provide the products and services to decarbonize transportation in Europe? And it's that perspective that we're driving strategically, and then in terms of the financial outcomes, it's one around value and not volume.
Okay, thanks, Jessica. Thanks, Emily. Marion, can I have the next question, please?
The next question comes from Konstantin Rosnov from Argos Media.
Good morning, Jessica, and good morning, Ben. Two questions, please. One is about your divestments. For 2021, given the current market situation, are you confident that you will be able to actually high-grade your portfolio rather than start selling value to hit your divestment targets? And the second question is about the energy transition. I just wanted to ask, how do you judge whether Shell is moving fast enough, slow, or at the required speed in the energy transition, and what gives you the edge in this kind of situation? Thank you.
Thank you very much, Konstantin. Jessica, would you like to take the divestment question first? And I'll talk a little bit about the metrics that we use to monitor the energy transition.
Sure, Ben. Konstantin, thank you for the question. In terms of the divestment program, at this moment in time, I'm feeling relatively optimistic. We had two important signings in the fourth quarter with our QGC infrastructure and a Nigerian asset. The proceeds from both of those will be near $3 billion, and we're hoping to get that within the first half of 2021. In addition, with the tick up in oil and gas prices that we saw coming out of the fourth quarter and into January, that's also picked up interest. We've received some unsolicited offers on some of our assets. So I'm feeling the market's relatively good, obviously coming off a very difficult market before. So I think the conditions are ripe for our divestment program. I'd also point out that through the last few years, when we've been through the low cycle, we've been able to ensure getting value for our divestment program. So I don't feel any pressure to sell below value. And as I said, I'm optimistic that the market conditions will support our divestment program.
And Konstantin, on the energy transition, there's a number of ways of looking at it. A lot of people, of course, look at, how much money do you put into the energy system of the future, or how much do you actually meet certain volumetric targets? And while, of course, we take a look at it and we And we need to see, indeed, how effective are we in pivoting our business models, our investment program, but also where we get the money from, our cash flows, etc., to that future business rather than more the legacy business. The only real way by which we can judge whether we are making progress is by looking at the carbon footprint that we as a company have on this planet. So that means looking at the carbon intensity of all the products that we sell. And we sell a whole lot more than we produce ourselves. So that is how we have set ourselves targets and ambitions going forward. We are tracking that very carefully. We said we want to be a net zero energy business by 2050. We set a target for 2035. And of course, we have longer term targets that we link the remuneration of our top executives and actually the top 12,000 people in our company to. And that's how we track. And we are making progress. We are making progress towards that target ultimately of getting to zero. But Constantine, I would say, come back next week. We're going to talk about that a whole lot more when we talk about the future of the company. Managing carbon is one of the key things we have to get right over the next decade and more. Marion, who's next?
We'll now take the next question from Nicholas Coleman from Platts.
Good morning, Ben and Jessica. I have two questions, please, one on refining and one on the North Sea. Firstly, on refining, could you enlarge a little bit on the future of refining and Shell's place in it? Obviously, for many years, we've had a narrative that there would need to be fewer refineries in Europe and Asia and China would drive the demand for refining. But do you have any more kind of nuance on that and any change in the picture as a result of what's happened in the last year and in terms of how Shell sees itself there? Second question on the North Sea, just wondering if you have any tips or you can provide any more information on this year, the coming year in the North Sea in terms of either investment decisions or projects going to start up, such as the Penguins field, for example, and anything there on the timing would be appreciated. Thank you very much.
Yeah, thank you very much, Nicholas. I will take them both. But I think on the precise timing of the startup of Penguins, etc., I do not have that information at my fingertips. Maybe it will be coming in the next few minutes or so. But I would say talk to our media relations people who give you an update on where we are with these projects. The future of refining is a tough one. We have been saying this now for quite some time. We do see a very difficult future for refining and have been acting on that belief now for years. When I look back at the beginning of this century, we had something like 64 refineries. We're now down to 15. And of course, we are in the process of high-grading that footprint to 6 energy and chemical parks that are based on our most advantaged assets. So if you just look at last year, we sold our Martinez refinery in California. We closed down our refinery in Louisiana, Convent. We repurposed our refinery in the Philippines, Tabangao, into a terminal. This year, we sold our refinery in Denmark, Fredericia. And we are repurposing the refineries in places like Singapore and also repurposing or looking at our refinery configurations in places like Pernis. So does it mean that we have no viable future there? No, absolutely not. We will just have a smaller footprint. It will be a higher quality footprint. And importantly, we will use that footprint increasingly as a platform to also integrate these facilities of the future. If you want to be a really successful biofuels player, it's not a bad thing to actually embed that infrastructure into our existing fuels infrastructure. If you want to be a real top player in hydrogen, it's better to take advantage of the positions that you already have with your refining footprint. And so therefore, and even when you talk about renewable power, quite often it's very useful to have a significant short in your refining position that you can optimize and play with. So we still believe there is a strong future for these assets in our company, but they will be smaller. There will not be refining for fuel's sake per se, but they will be much more efficient. And again, I would suggest you contact our media relations folks when it comes to the North Sea. Thank you very much. Marion, next question, please.
We'll now take the next question from Mark Lamy from Energy Voice.
Hi, thanks for taking my question. And apologies for echoing Nick's question there. I did just want to ask the oil price is quite a bit higher. I think it's near a year high, although you'll want assurances that it's not going to go back down anytime soon. But do you have enough confidence now to be able to make some investment decisions, some of the ones that were deferred last year in the North Sea, perhaps as soon as, the second half of this year? And we know that you've said that the North Sea is one of your 9 core regions, but with the job losses planned, including in Aberdeen, over the next 2 years, can you give assurances that that's going to remain the case for the foreseeable?
Well, thank you very much, Mark. And I think, we spoke about the need to reshape our company setup, which means that we have to reduce the number of staff working for us with 7,000 to 9,000 people. We try to do it as much as possible, of course, on the basis of voluntary severance. We just are in the middle of a second round to which people respond quite well. And let me very clearly also say, we have avoided forced redundancies during the pandemic. Now, we probably see redundancies coming later in the year, and indeed we also see redundancies coming in the UK, in the Netherlands, and that is something that is the reality of the fact that we have less activity and that we have to also look very hard at our cash preservation measures in order to keep the company strong and financially resilient. But to go back to your other question about the oil price is indeed doing remarkably well. I think it's somewhere around $59 as we speak, I believe. And that, of course, is a very strong recovery. And if you would go back maybe half a year, a lot of people would not have predicted that recovery to be as strong. Now, some of it, of course, is to do with the fact that indeed demand has come back, but demand hasn't come back to the levels that we have seen before. A lot of it is therefore also to do with the restraint of OPEC Plus on supply. How will that play out? I hesitate a lot to make predictions on this, but I would probably want to say that, I expect to see a bit of volatility in the market for the next months and quarters to come. And we don't plan our business, by the way, on $60 oil. We plan it on a much more conservative level. But am I optimistic? Yes, absolutely. I am optimistic that in the second half of the year, we see a much more fulsome recovery. In many parts of our business, we see already in chemicals and already in marketing a significant recovery. And I would imagine also in upstream and more to come, of course, in 2021. And yes, indeed, there will be more room for us, therefore, to spend. As a matter of fact, some of the spend that we avoided last year, $7 billion that we avoided last year, will automatically be bumped into this year. Because we will not be able to defer that spend yet another year, particularly not for projects that were under execution. But we will restrain our spending very clearly to a level of no more than $22 billion, if that, until we have reached the key milestone of $65 billion net debt, at which point in time we will first raise payouts to shareholders, 20 to 30% of our CFFO, and we will also start thinking at that point in time maybe about a little bit more capex, but also a continuation of our reduction in debt. Now, I think that is probably the last question. In the meantime, our media folks have done an amazing job in looking at the Penguins question. So I see here that it's expected to be delivered in the early 2020s. Subsea work has been rephased across 2020 and 2021 to reduce the capex that I just spoke about. We expect first oil probably in 2022. But anyway, thank you very much for your questions, and thank you very much for joining the call today. I really hope this has given you some insights into our performance into 2020, how well we are positioned, and how well we are positioned not only for this year, but also for many years ahead. But there's more to come at our Strategy Day on the 11th of February next week. We tell you more about how Shell will power progress, while, as I said, our cash priorities remain exactly the same. And we plan to further provide you with insights on our strategy and our business pillars through the additional events that we will have over the course of this year, 2021. So, have a great rest of the week. Please stay safe and speak to all of you next week again. Thank you.
Thank you. That will conclude today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.